Hello, everybody, and a very happy new year to all of you. Welcome to KA Pundit's latest video to introduce our thoughts and observations on the interest rates affecting accounting for employee benefits in India as at 31st of December 2022. What we have seen in the last trading day of the year is a yield on government securities that continues its upward slope in the very short term, and quite a drastic slope there, up to about 5 to 6 years durations, and after which then the yield curve very much has continued its long-term pattern of being reasonably flat. When we compare, however, what's happened in the last 1 year, there are two main observations I would highlight to everybody. The first is that in those very short durations, we've seen a drastic increase, of course, with all the global fiscal macroeconomic issues that are happening and how governments are reacting, and of course in India as well, to manage expectations, inflation, and the economy going forward. So we see a large increase in yields as compared to about a year ago, especially in the short term, but in the long-term durations as well, there is an increase as compared to 1 year ago. That's the first observation. The second observation is that in the second half of 2022, however, we see that the yields have dropped just a slight amount. So compared to June 2022 and September 2022, the December rates are a little lower, but the overall pattern remains the same, with an upward sloping curve and reasonable stability in durations that are after 6 to 7 years. The impact of this, of course, higher interest rates as compared to a year ago means that obligations are lower, and depending on the assets that you hold, any market-related, government debt-related assets that you have will also have experienced a drop in value as a result of the higher yields. And so that's something to look out for as we approach valuations for the end of 2022. But looking forward towards the fiscal year end of March 2023, we do need to keep a track on what might be happening there in the next few months. Various reports in the financial press, in the RBI, probably expect the interest rate yield to hover around a similar amount, if not a little bit higher, depending on decisions taken by the various central banks over the next few months. But what we think is probably you are in that sort of bracket of about 7 to 7.5, maybe 7.75 in those longer durations after 10 years. Now, the impact on everybody will, of course, be very different. Depends on if you've got very short-term liabilities, high attrition type of scheme, companies with schemes that are paid out in lump sum, they may be impacted more as compared to last year because the increase in rates has been far higher. And of course, the impact will be maybe a little less on those long-term plans, which have durations of maybe 15, 16, 17, 18 years, long-term post-retirement pension plans, post-retirement medical plans, etc. So important to look at your particular situation and take a stock there. So thank you very much indeed. And please do read the article for more details and get in touch if you have any questions at all. Thank you and have a great rest of 2023.